Hello, and welcome to Fireside with the VC. My name is Andrew Romans, and we are blessed today to have Jeff Epstein from Bessemer Venture Partners on the podcast. Jeff was CFO of a number of publicly traded companies before joining Bessemer, one that you should have heard of, DoubleClick, which was, I believe, Jeff, wasn't that the biggest acquisition in Google's history at the time? 3.1 billion, is that right?
It was. Mm-hmm.
You were then working with, I guess, Larry Ellison at Oracle as chief financial officer of what I think of as the SaaS company of all SaaS companies, 150 billion at last time I looked, very profitable.
Well, they are increasingly a SaaS company. Of course, for 30 years, they were an on-premise software company, the largest enterprise software company in the world, the most popular database. And Safra Catz, who was my boss at Oracle, is now the CEO of Oracle, is just a tremendous leader. So I worked with Safra and Larry.
That's great. You know, to show how old I am, I once keyed into my closet when I was running my startup, ripped a CPU out of my $50,000 I paid for it Sun Spark to lower my Oracle bill. So, that just shows you how much more capital efficient companies can be, in today's world. But here's the topic I want to get in with you and everybody today, which is how many financings should a startup go through when they're accessing the venture capital machine that includes Bessemer and our fund and others, to kind of walk through pre-seed, seed, late stage seed, demo day, seed extension, A, B, C, D, E, and what do they need to show a VC in order to get a Series A? What should they be showing at these different levels? And the metrics will be different for consumer, SaaS, enterprise, mobile. I think of you as a world expert, on this kind of stuff. But before we get started, just to orient people, DoorDash, I think, is one of your deals. How many financings did DoorDash go through before getting into an IPO?
DoorDash is actually one we missed. We have an anti-portfolio at Bessemer, and I had a chance to meet DoorDash at Y Combinator and was very early on, but they didn't let me in as an angel in the very first round. My friend, Mar Hershenson at Pear Ventures, is an investor, and she was been very early on from the whole, the entire life cycle. So that's a great example. DoorDash has probably done 8 or 10 financings from its pre-seed to its IPO. And the first round was in 2013 when they had probably hundreds of dollars or a few $1,000s of revenue. They raised $120,000 at 2 million pre. And then later that year, they raised 2.4 million seed. A year later, a 17 million Series A. A year after that, a 40 million Series B. A year after that, 127 million. Then they skipped a year, raised 500 million Series D. Again, raised that year. So pretty much every year from 2013 to 2020, they raised another round. And every round was a higher valuation. There was one period where they had essentially a flat valuation when they were struggling. And now, of course, they're worth tens of billions of dollars as a public company. So the two questions that you asked, one was when should you raise money? And the other is how much should you raise? The when question in my mind is you don't want to raise more than once a year, because then you're just constantly fundraising and you're not focused on your business. And you probably don't want to raise, if you're consuming capital as most startups are, you probably don't want to raise money now if you're not going to spend it for the next 2 years. Mm-hmm. Because if you're going to raise money now and spend it 3 years from now, the chances are 3 years from now you'll be worth more. So why not wait and raise money later? So you basically want to raise a year or 2 years worth of money every time you raise money. And you want to raise more if the market is great and the valuations are high and you're doing well. You want to raise less if the valuations are lower, the market's a little lower, because you're going to get a higher valuation later. So somewhere between 1 and 2 years worth of money every time you raise money.
And now, just on that topic before moving on, how do you think about runway? So runway meaning you've got monthly expenses are here, burn rate is there, you bring in capital, you've got an operating plan. How many months of runway do you have before the bank balance could potentially hit zero?
Well, I think the classic answer to that is the day you close in your financing, you should have 18 to 30 months of runway. And the idea is that your next financing will probably take 6 months from the day you start to the day you close. So if you close today and you have 18 months of runway, that means a year from now, you need to start your next financing.
Right.
So it gives you a year without raising money. So a year you can focus on your business. If you have less than 18 months, you have to start raising money 9 months from now or 6 months from now. You don't have time to run your business. So I would advocate a minimum of 18 months and then a maximum of 30 months, because if you raise more than that, that means you're raising money now for today's valuation, but you could be raising money at a future valuation.
Okay. And so with why don't we start at the beginning? What should startups be seeking to demonstrate when trying to raise that first outside capital? So I guess let's talk about pre-seed, from an angel perspective or an institutional seed investor.
There's no specific answer. There's more trends and generalities. So I would say generally what you want to do whenever you raise a round, well, let me take a step back. Why does venture capital work? Venture capital works because it's a gated capital. The example of this is DoorDash, which raised money every year, and every year they did well, and they proved to investors that they were growing and they were having better product market fit and better go to market, and they were worth more. The opposite of gated capital is what Quibi did. Quibi, you may remember, was the company started by Jeffrey Katzenberg and Meg Whitman last couple of years ago that raised $1 billion and spent it to do quick bites. That's what Quibi was. It was short form video for mobile phones. And they raised money. They raised $1.7 billion before they had their first revenue. And then 6 months later, they shut the company down and they lost over $1 billion. So that's the opposite of venture capital. That's right. Just give me a lot of money. I'm going to spend it all and hope it works. Venture capital is give me a little money. In the next year, I'm going to prove something. And then next year, you'll give me more because I'll go through the gate, and then I'll prove something else and I'll go through the next gate. And every year there's another gate, or every year or two, there's another gate that I go through. And the reason that has worked, and it's worked now for 50 years in Silicon Valley, is you're not spending $1 billion all at once. You're spending a small amount of money to prove something and then spending a little more to prove something else. And every step of the way, if you don't prove it, you won't be able to raise your next round.
Right.
And at that point, if you can't raise your next round, you have to get to break even or shut the company down.
I think drug discovery biotech is almost a hyperbole example to pass this logic on of saying, if phase 1 trials are on animals like rats and it kills all the animals, why would you test it on a subset of humans? Why would you test it against it? You're not going to pay, you're not going to put the money in now for phase 4 clinical trials when we could be dead in the water with an A/B test on phase 1. Of course, you can argue about the team, the market, some core tech and pivoting, in a world of pivots. But even then, that is adhering to the kind of biotech logic of pivot and show me some metrics. So I want to get into some metrics. So what do you think? Sometimes some companies, hardware related, may need more capital. So every person's unique, every startup is unique, but we're going to be generalizing here and not worry about too much uniqueness. If you raise too much money at the seed, you may get diluted a lot, and you've got what I often think of as dead weight in the cap table. When if you're going to a Bessemer for a Series A and they think this could have another 8 financings before a multi-billion-dollar IPO, you don't want to delete yourself too much, but yet you want to be attractive. So what's a suitable amount of capital to raise at a early seed round, before you go into an A?
Well, for software companies, before this year is pretty extraordinary. People are raising a lot of money at high valuations, but the classic would be, how much money do you need for the next year or two to run your little software company with a handful of engineers who are building a product, and you don't really need anything else. And it's typically a few $100,000 for your pre-seed and maybe $1 million to $2 million for your seed. And the idea is, can you raise enough money to get to the next gate? So the question is, what is the next gate? Mm-hmm. So if you start with just an idea, the next gate is, can I build a prototype of my product that I can put in the hands of customers and they can start using, so I can see, do customers say, I'm giving you the product for free, but I don't really find any value from it, so I'm not even going to use it. That would be that's the equivalent of the animals dying in your example.
Right.
Or customers love it. They're using it every day. And they tell me, this is great. Everyone has to make money. So actually, even though I'm getting it for free, I'm happy to pay you a fair price because I'm getting a lot of value. So that would be terrific proof of product market fit. In a B2B software context, my definition of product market fit is, do you have 10 paying referenceable customers?
Okay.
Because if you don't, then I'm taking a lot of risk as an investor. Who knows whether it's going to work? Once you have 10 paying referenceable customers, and I, as an investor, would literally call up all your customers and say, tell me what you use it for. What did you used to use? Why do you use it? Are you in it every day or every week? What's the value you're getting from it? How much you're paying for it? How much you're willing to pay for it? And 10 is a broad enough sample that they're probably not all your college roommates. They're probably in different sectors, different sizes, different geographies. And if you have 10, I think you could probably get 11. If you have 11, I think you can get 12. So you've proven product market fit. Now that's just my own personal rule of thumb. Other people have different definitions of, if you Google product market fit, you'll see lots of different definitions. And it's different for consumer. You need a lot more customers for consumer free or consumer paid than B2B. Then once you've gone through the gate of product market fit, then you could probably raise your Series B round. And then you're saying, okay, now I have a product that works. Now I want to scale it up and get a lot of customers.
Right.
And so now you're going to, if you're a consumer, you're going to spend money on marketing. If you're B2B, you're going to hire salespeople and spend money on sales. And then the question is, do I have a repeatable sales or marketing process where I know if I spend $1 on sales and marketing, I'm going to get $1 back or get 50 cents a year back. So I get a 2-year payback. And the key metric we look for there for B2B is a payback of a customer acquisition cost payback of 2 years or less. Meaning if I spend $1, we want you to get at least 50 cents back in profit this year, meaning you've broken even in 2 years, and in the third year, you're making money if you get a customer to renew.
Okay. Getting that CAC to LTV is important. I think when we look at early SaaS companies, sometimes even getting four enterprise customers that are paying money, but are even driving functional requirements. Sometimes you might even see one of these companies co-invested with us or is in the round or invested before us. But sometimes I think when you're still at that Bunsen burner science experiment stage, trying not to go for a lot of logos and going, a bit closer on a few, they can even help the startup figure out, what they should be doing, what the product should be doing, prioritizing, release on functionality and things like that. But so for you, 10 enterprise customers could be enough to go for a Series A round?
Well, typically that would, the definitions are changing. I would say
Very blurred
lines. It used to be Series B. Now, it used to be Series A. Now it's probably seed. I mean, it's getting, the rounds are all getting bigger, and you're getting grade inflation essentially in the rounds. What used to be a Series B is now a Series A. What used to be a Series A is now a seed. But right. the point is, have you, the key, forget about what they call it. The question is, have you proven product market fit?
Okay.
And some investors are comfortable investing very early before there's a product. Other customers want to see a product demo, even if you don't have paying customers and you don't have product market fit. Other investors say, no, I want to see product market fit. I want to see paying referenceable customers. And then there are still other customers that say, no, I want to take even less risk. I'm willing to pay more. I want to see that you have a repeatable sales process. So typically that's those gates that I just described. First, you've built the product. Then you've built the product and have customers using it, paying for it, and are referenceable. Then you have customers and you'll be able to sell it, and you have multiple salespeople selling it and making quota. Each of those levels, you get higher and higher valuations and lower risk for the investor.
Sure. And what do you think are, even when you're looking at friends of yours or companies you're actively involved with economically, what do you think are, as you get bigger and you're breaking out of your late seed demo days and heading into more of we have a repeatable sales cycle, we have plenty of customers, we're landing and expanding. What are the key metrics with revenue and other than revenue? And feel free to break it down a little bit. Of consumer, you might want to see more people using it every other day. Essentially, dogs are eating the dog food. But on the enterprise side first, what kind of revenue marks or other key metrics are you looking for when a company is, say, raising 5 million plus? So if that's a big seed or if it's an A these days.
Well, I think the milestones are typically $1 million of annual recurring revenue. You sort of get into a new level where these are arbitrary. So it's really in the minds of the investors. There's a group of investors that won't invest if you have less than $1 million of ARR because they just say it's still too speculative. There are other people who say, once you've gotten to $1 million of ARR, we think you've reached some sort of key threshold. We think the risk of you going out of business is a lot lower. You clearly have a number of customers who are paying for it. At that point, you might have, if you're selling something for $50,000, you might have 20 customers. The next metric would probably be about $5 million of ARR, where now you're pretty established, but you have several salespeople. The salespeople are making quota. So you have, at that point, you probably have a repeatable sales process. You might be growing 100 or 200% a year, but losing a lot of money. Losing a lot of money typically doesn't bother venture investors. In fact, they like that because the venture investors bring capital. So if you're losing a lot of money, you need more capital, you need the venture investors more. If you break even, maybe you don't need the venture.
It's hard to negotiate.
Right. So what we love to see as a venture firm is a company that has $1 million to $5 million of annual revenue, has referenceable customers, has salespeople making quota, is growing, is doubling or tripling this year, and is losing a lot of money. Then we can write a big check. We can help you grow, but you've already proved, you've taken a lot of the risk out because you've proven customers like it. You've proven you can sell it. And it's just a question really of how quickly can you grow and how big is the market.
And hopefully with that CAC to LTV payback period, you're able to see a path to profitability, even if they're aggressively growing the business as a loss-making company.
The metric that I focus on is not CAC to LTV, which stands for lifetime value. It's CAC payback, meaning
CAC meaning cost to acquire your customer.
If you're a good software company, you'll have a net renewal rate above 100%, meaning if you start with 10 customers this year, a year from now, maybe you'll lose a customer, but the 9 who are left are going to buy more. So you'll actually have higher revenue next year than this year with no new customers, meaning you'll have a net renewal rate above 100%. And so in that case, you have an infinite lifetime value, right? Because your revenue is actually growing over time with no new customers. You only have a limited lifetime value if you're losing. If you sign up 100 customers this year and next year you only have $90 of revenue and the year after that $80 of revenue, then you have sort of a 10-year lifetime value. So the best customers, Oracle today, 40 years after its founding, I'm sure has customers who were customers 30, 40 years ago. So essentially a very, very long lifetime values. The key metric is CAC payback. So if I spend $1 of sales on sales and marketing, how much gross profit do I get in the next 12 months? Do I get a year's worth, in which case I have a 1-year payback, or does it take me 2 years to earn it back, or only 6 months to earn it back? And what we like to see at Bessemer is a CAC payback of 2 years or less, meaning I'm earning my sales and marketing back in less than 2 years.
Right. I think of one of the metrics for SaaS companies is you've got, revenue, that's obvious. Everyone understands that growth, but there's also number of customers, and are you growing the average contract value? So the amount of money you can get out of that customer in a year. Often these companies, as they grow, they're adding more engineers. The engineers get something done, move on to the next product extension. If they're able to synchronize into more data sets and offer more value, maybe save more money, make more money for their customer, it's worth it for the customer to start off paying $2,000 a month or $2,000 even a year, and then double that and double that. So that's kind of one of the SaaS metrics that we pay attention to. Okay, and what if you were to list a couple of the metrics you look for on the SaaS? So enterprise software companies, obviously revenue growth is key, number of customers key. What are, CAC to payback? That was a key one. What other things come to mind? Like even churn levels or?
Yeah, the gross churn and net churn. So if you start with 10 customers a year later, how many are still customers? And then how much are they paying relative to how much they were paying before? So the example I gave where you lose one customer, your gross churn is 90%, or it's 10% churn, 90% gross renewal rate. But if those 9 are each buying 30% more, you might have 120% net renewal rate. So we want to see a net renewal rate above 100%. And we want to see a gross renewal rate probably above, ideally above 90%, where not too many people are canceling. Then we also want to see product market. If it's an early stage company, you can do a survey about product market fit. There's a famous survey about how disappointed would you be if we took away this product, and you want to see 40% or more say they were very disappointed. If the company has been around a lot and you have enough customers, you could do a net promoter score survey and saying on a scale of 0 to 10, how likely are you to recommend this to a friend? So the net renewal rate is probably the most important, but product market fit and net promoter score are sort of surrogates for figuring out customer satisfaction. If you have salespeople, you want to see, are most of your salespeople making quota? And what's the ramp rate? How long does it take to get? How many salespeople are staying versus you have churn in your sales force? If you're a marketing company, you want to see what's your ROI on your marketing. What are your channels of marketing distribution? Are you mostly marketing through Facebook or Instagram? Are you mostly marketing through Google Search or Google Display? How big is the market? If you're advertising in a certain unique set of keywords, but you're already buying all the keywords there are, and there's not enough traffic. What you look at is, look at the keywords that you're buying on Google and say, how many people are searching for those things? If only a few people are searching for them, you might have maxed out you might have great ROI on your Google AdWords, but you bought all the AdWords there are for your particular unique niche, and you can't scale it. So then how are you going to get new customers if you can't do it through Google? You have to come up with new ways of advertising. So in anything that has a marketing component, the marketing channel metrics are very important.
Yeah. And for entrepreneurs going through all these financings, DoorDash doing 9, 10 financings before an initial public offering, what is dilution expectations on both sides here? So if investors are investing $5 million, call that a late seed or small A these days, how much should the company be selling in these different financing rounds?
Most of the leading venture firms have ownership guidelines. So if you're a partner at a firm like Bessemer, you'll probably be sitting on 8 or 9 or 10 boards of directors, and you can't be on 20 boards of directors. So you're only going to make 10 investments over the course of 10 years. So every year you're making 1 or 2 new investments. And you want to start with, let's say, 25% ownership of the company, so that you have a board seat and you have a meaningful ownership, as opposed to just having 5% of the company. So that's the classic venture capital model that many of the leading firms adopt. And then you could just do the math. If you're raising 5 million and Bessemer wants to own 25% of fully diluted, then the pre-money is going to be 20 million. Because then you'd have 5 out of, actually it would be 15 million, because you'd have 5 out of 20 million. And maybe you could go down to 20% or 18%, but typically they'd want a meaningful ownership position in a board seat.
Right.
That's the classic.
In ancient times of the 90s, when I was first raising funding for myself, you just double the size of the round to get the pre-money. We're raising 5 on 10, that's 33% dilution. I think as time has gone by, companies tend to want to sell closer to 20% in a single financing round. And then you have the dynamic of, well, I've got Bessemer and Sequoia, both want to support us. Maybe we can cut it in half. And these ownership target percentages of owning at least 20%, which I hear most commonly are 25. I guess it's good for you guys to get a big ownership chunk early, and then maybe pro rata your way and double down as they get lower risk to, maintain or grow into that.
Yeah, it would be rare for 5 or 10 million early stage financing to have 2 lead venture investors. Typically, the CEO says, why complicate life? I'm just going to pick one of them that I like better, that either gives me the higher valuation or I think is higher value added for your Series A, let's say. And then a year or 2 later, when you do a Series B, you'd go back to the other one and say, look, I'd like you to lead the Series B to set the price, because my insider isn't objective anymore. So I want an independent person to pay a market price, which I hope is going to be a very high price, as opposed to the insider, which might give me a low price. And then the insider typically will match and say, I'll buy my pro rata. So the new investors coming in, setting a high price, and your earlier investor is matching that price and investing its pro rata share.
Yeah, I think that's standard. If the existing investor is setting the price, they could be marking up ahead of even their own fundraise. And it's good to have that impartial guy who said, I'm willing to trade cash for this good at this price, to validate that. So what are you seeing is changing in 2021? I mean, we've seen some of our portfolio companies raise pretty big financing rounds in the hundreds of millions of dollars when their revenues maybe even a year ago might not have justified such a big check. What's shifting? Maybe where were we 2 years ago? Where's the market right now on what is changing?
Well, all markets, whether they're venture capital markets or private equity markets or the public stock markets, go through cycles. We are at the best of times, part of the venture capital cycle now. It's just most venture firms have made a lot of money in the investments they've made over the last 5 or 10 years. Money is pouring into their funds, and the funds have to invest it. And then you have new entrants like crossover funds that typically invest in public markets that have been investing in late stage venture. And you have family offices and individuals and angels investing. So it's the easiest time to raise money at high valuations that it's probably ever been in the history of venture capital. And so if you have a great idea, today is a great time to raise money. Now, it's not going to last forever. What's going to happen is some of these companies are not going to make it. Some of the companies are going to raise money at high valuations, and ultimately, even though the company does okay, the investors lose money because they invested at too high a price, and then there'll be some correction. But right now, it's a great time to raise money.
And what are your expectations as a venture capitalist on how much you think you can make? So if you're investing in a company with a $25 million pre-money valuation, you're putting in whatever number of dollars, what are you seeking to make on that investment? Kind of like late stage looking for maybe 4x, early stage looking for something much bigger.
Well, at a venture fund, the classic venture fund is looking for a 3x rate of return on average across the portfolio. And at a firm like Bessemer, we typically are taking a lot of risk early stage. So a third of our investments, we lose all our money.
Okay.
And a third we get our money back, and a third we make a lot of money. And so we need to make 10x or more on the winners to compensate for the ones where we lose all our money. In private equity, a friend of mine was at a private equity firm that's 30 years old, very successful. They've made hundreds of investments. They've never lost all their money on any deal.
Right. Okay.
They have 100% rate of, in fact, I think they probably have not lost their capital on very few deals. They probably have over 90% of their deals probably at least make their money back. And they have a 3x return in their fund. So they're trying to make between a 1x and a 5x return. We're trying to make between a 0x and a 100x return. So we end up all making a 3x return if we do well, maybe a little better in a time like this where everyone's doing better. But we have a lot more variability.
Okay, it makes sense. And as we move into some of the later stage, it used to be when you were CFO of numerous companies, the market capitalization was possibly lower than the pre-money valuation of what still seems to be in the venture capital ecosystem with these crossover big funds like Tiger Global coming down. When a company wants to be raising money at $1 billion full-blown unicorn valuation, what do you think the market wants to see? What kind of traction should these different kind of companies have when they're hitting that $1 billion valuation?
Well, all of the investors are looking for the same thing, which is they'll typically map out the next 3 to 5 years of growth. And they'll say, look, if you're growing 100% a year, even if you only have 30 million of revenue now, if you're growing 100% a year and we think you can keep that up, pretty quickly you get to a big number. So you grow from 30 to 60 to 120 to 240. And if you have 240 million of revenue and you're still growing, maybe not 100% a year at that point, but 50% a year, you're probably worth many billions of dollars. So $5 to $10 billion, 20 plus times revenue. So you can just look at the public companies, look at their growth rate, their profit margin, and say, the range of valuations are something like maybe 6 times revenue for a slow growth company like Oracle to 30 or 40 times revenue for a high growth company like Zoom. And you could see where you fit in that comparable. And then you'd say, okay, well, if I'm private today, but in 5 years I'll be public, and in 5 years I'll be this kind of revenue and this kind of growth rate, will I be at Oracle's multiple, or will I be at Zoom's multiple, or somewhere in between? You discount that back, and that's how you come up with the billion-dollar valuation for a company with 35 million of revenue today.
Sure, sure. So, and what do you think are minimum revenue valuations for a high growth SaaS company on getting to $1 billion valuation while private?
Well, I would say that depending on the growth rate, companies are being valued anywhere from 10 times revenue to 30 times revenue, and some high growth companies even more. I mean, if you're growing more than 100% a year, they're not looking at today's revenue, they're looking at your revenue 2 or 3 years out.
Sure, sure. And if you were doing the Jeff Epstein playbook of this is how much you should be doubling or multiplying revenue in the early years of, like, you've got your 10 customers, you've got 100K MRR, so you're at like 1.2, growing to 500K MRR, which will move you from one investor set to another that will be willing to support you, like you said in the beginning of our talk today. How much should they be doubling, more than 2xing? Does that throttle up and throttle down? I think I've heard you talk about that before.
Think about it from the investor's point of view. Investors have venture investors have a fund life of 7 to 10 years. So when we make an investment, we want to be able to either sell the company or take the company public and cash out in that 7 to 10 year period. So, and we want the company to be worth more than $1 billion. So roughly, let's say it has 100 million of annual revenue at that point when we're exiting. So how do you get from 0 revenue today to 100 million of revenue in 7 to 10 years? And the answer is there's 2 phases. The first phase is you struggle a little bit, you get your first customers, and it takes you a few years to get from 0 to 2 million of revenue, let's say. Once you get to 2 million of revenue, you've got product market fit, you've got a repeatable sales process, you should be growing very fast. So there's a series of articles out on the internet, you could look it up, called triple, triple, double, double, double.
Right.
So from 2 million, you want to go from 2 to 6 in 1 year, then 6 to 18. So you've tripled every year for 2 years, and then double from 18 to 36 to 72 to 144. Then you've gone from 2 million to 144 in 5 years. Mm-hmm. And you've gone from 0 to 144 in about 8 years. So that's best case. And there are a lot of companies like Slack and others that have done that. We've been fortunate at Bessemer to have a number of those as well. So if that's what venture investors always want to see in a perfect world, and they're willing to pay a lot for it if they think you're on that track. Now, of course, out of 100 venture-backed companies, only 1 or 2 are going to have those kind of metrics. But still, if you're at 2 million of revenue, you should be growing at least 50%, probably 100% at that point, even if you're losing money. The trade-off of growth versus profitability, what we all want to see is we want to see the growth. The growth proves that you have a product people want, proves you have a way of getting that product into customers' hands. The fact that you're losing money isn't a problem because we have money. So that's the whole point, is we want to give you money for you to invest in your product, invest in your go-to-market, so that you can get big within a 5 to 7 year period and get over 100 million of revenue.
And what should founders, we talked about the venture capitalist ownership target percentages of 25%. And if I'm doing a deal a year and I'm on 10 boards, what's the expectation of entrepreneurs what's their ownership at the time of, say, M&A can happen anytime. So maybe easier to have this discussion around an IPO. If you do an IPO on a big boy exchange on the NASDAQ, what percentage should management have going into that, let's go to one class of common shares event?
Well, I think the most dilution some investors get if they raise a lot of money every year and they continue to lose money, so they have to keep on raising money. Let's say there's 2 co-founders, they might be down to 5% each. Yeah. By the time they go public. The opposite of that is a company like Shutterstock, where I served on the board for many years. And John Oringer was the first employee, didn't have a co-founder. He was an engineer, he built the product, he went out and he marketed the product. It's a marketplace for images. He went out and personally took 100,000 photographs. So he basically did everything himself before he started any employees, and he generated revenue really early on. So he never raised venture capital. Right. And he finally raised a private round from Insight, which was all secondary, to take money out. So the company today is worth $3.5 billion, and he personally still owns half the company. Sure. So that's sort of the best case.
I mean, that's when you talked about a CAC to payback period, some companies just really, really work on unit economics. I remember moneysupermarket.com in London was putting out ads saying we can save you money on your auto insurance if you change, and a million other things. And then they have the money they spent on that ad. And when they switch you over to a different service provider, they get a lot more back. And it was happening not in under 2 years, it was happening in the same, cash period. So that the founders owned 82% when they listed, on the LSE. So, I mean, that's an example of those really great unit economics can carry you. So I want to close out on secondaries. So what are your feelings about secondaries? Secondaries have evolved quite a bit. It used to be in ancient times, oh, if Bill Gates is selling shares in Microsoft, we should all dump our Microsoft shares, and it's like a run on the bank because he knows more than we do. Then we kind of had dot-com meltdown, 2001, Sarbanes-Oxley, stay private forever. There's only so long these funds can stay open for, and the secondary market's kind of evolved. What are your thoughts about that, and what do you see happening? And when are founders beginning to see personal liquidity in these financing rounds or in between?
There's a balance. As an investor, you want the founder to be focused on their business, and you don't want them to take month-long vacations to the Caribbean because they've made millions of dollars and are sailing around on yachts and not care about the business. You want them to be working pretty hard. On the other hand, you don't want them to be worried about money, because then that's dysfunctional too. If the founder is married and has kids and has a family, they probably, they might want to buy a house. They might want to send their kids to a good school. And so what has happened now is most investors are certainly open and eager to let founders take out some percentage of their ownership. The venture investors are diversified. We all have lots of investments, and we have live in nice houses, and we have we're not risking our entire net worth on one company. If you're the founder and 100% of your net worth is in illiquid stock in one company, and you can't afford to live in a nice place and take a nice vacation once a year, I think you're not having a balanced life. So I think it makes sense to say, let's say, sell 10% of your ownership is certainly reasonable. Get some cash out, have some diversification, as long as most of your wealth is still in the company and you're still working pretty hard. The company is the right balance.
And that can serve to align interests too. That if the founder were not able to do any kind of secondary, they're trying to keep burn rates low, so the kids are not skiing or going to a good school. They might be keen to push for the first offer to sell the company in an M&A, where a venture fund like yours that's been around for over 100 years is thinking, well, we'd rather wait a bit longer, raise more money, soldier on a bit more, and get to that multi-billion-dollar listing exit. So, sometimes it can be aligning. So, Jeff, what is the criteria these days for Bessemer? I'm sure if relationships exist, you guys might be investing earlier, but when is typically a first entry point that one would see where Bessemer is going to invest in a startup on the early side?
Bessemer has evolved over the last several years. We now invest at every stage. So we'll write $100,000 seed checks into companies with pre-product, and we'll write $100 million late stage checks into companies just before they're going public, or even buy stock in a company at the IPO. And we have 20 investing partners. Each of them we invest according to roadmaps. So each of our investors have 2 or 3 areas that they focus on, whether it's cloud software or consumer or healthcare or cybersecurity or drones or space or batteries, whatever the category is. So if you have a company that is looking for venture capital, feel free to email me, jeff@bvp.com, and I'll get you to the right partner. And then that partner would take a look at it. And the partner will want to be the lead investor on about 10 deals over at any one point in time. So every year they'll be selling a company or taking a company public and making 1 or 2 new investments, but they'll also be making a handful of earlier stage investments as well in seeds, because they want to get a look at, if we invest in a seed, we want to get first look at the Series A. So that's the main reason we invest in seed.
Okay. And what does operating partner mean at Bessemer? I mean, as an operating partner, what is your function role? I'm sure everyone does a bit of everything, but how would you describe that?
Well, investing partners write checks. They have the authority to make decisions and commit capital. I don't. So I'm an operating partner, not an investing partner. I get involved after Bessemer invests, and then I help the CEO and the CFO of their company build the business. And the way we think about it is, typically the founders of the company are product people or engineers, and they build the product. Sometimes a co-founder is also a go-to-market person, a sales or marketing expert. And initially you have one product and the company is the product. And then over time, what you're doing is you're not only building the product, but you're building the company that builds the product, because you need to hire more people. You need to expand from your first product to your second product. You might want to expand from one market segment to another market segment, or from the US to international. And my experience as a CFO over 25 years is building the company. So what I and my colleagues at Bessemer and our operating group do is we help, in addition to providing capital, in addition to the board member who's the investor sitting on the board and helping the company, our operating group helps the company build the infrastructure of the company and processes, systems to grow from this $1 million or $5 million revenue level to $100 million of revenue and more.
That's what I like to hear. Building companies one brick at a time, and with your network and background, they're lucky to get you in their circle. So, what closing question? What's the one thing you would throw out to entrepreneurs as advice, or something to keep their eyes on in 2021?
Well, Paul Graham has said it best, the founder of Y Combinator. If you're a very early stage company and you're pre-product market fit, there's only two things you need to do. One is make products and services people want. And then number two is grow. That venture-backed companies are all about growth. So first you have to make something people want. And then once you have it, you have to figure out, well, how do I get more of those people? And you can start very small. You know, Airbnb started renting out airbeds to people in their apartment. They didn't start, renting out vacation homes in Hawaii. And of course they evolved into that. And Uber started with black car service, not with every cars. And companies like DoorDash started with the founders personally driving, going to restaurants. They didn't sign up restaurants. They went to a restaurant and said, I'm going to buy some food. And then they just drove it to someone's house. The restaurant didn't even know they were a delivery service. They just thought they were guys coming in getting takeout. So you could start with a very simple product, find your first customers, and then figure out how to grow. And that's the key to it.
Okay. Well, Jeff, thanks so much. I look forward to our little sandwich Teal Flow meetings again. Thanks for sharing today's wisdom.
Great. Andrew, thank you very much. It's a pleasure being here.
Okay. Talk to you soon. Bye for now.